Good afternoon. Welcome to the most exciting webinar series on the planet. This is Bridget Nurnberg for the FPA of Massachusetts. Our goal is to build it better, do it differently, and be relevant for today. Our goal with this regular monthly webinar series is to inform you about upcoming timely topics, and we want to make these webinars the best that they can be. I'm excited to announce we have a July 22nd free CE day. That's at the UMass Club in Boston, and that's free for members. Go to our website, FPA of Mass, to get details on that. And once again, it's July 22nd. And now it's time for some cutting-edge stuff. We have the FPA is fortunate to have one of our own chapter members, Chris Chen and Tom Sater, give a presentation on today's topic being divorce. It's a major life event that can turn a client's personal life upside down and drastically alter a client's financial well-being. This webinar will focus on the major issues that financial planners need to know about divorce in Massachusetts. The presenters are well-established specialists in the Association of Divorce Financial Planners and the Financial Planning Association. Chris Chen is a certified financial planner practitioner and a certified divorce financial analyst, CDFA, and he has a bachelor's from the University of Rochester and an MBA from the University of Texas at Austin. Tom Sater is a certified divorce financial analyst, and he has earned his bachelor's in psychology from Harvard. Tom and Chris, welcome to the FPA of Massachusetts. The stage is now yours.
Okay, thank you, Bridget. We appreciate that. So just wanted to start with a few disclaimers. We would not be a financial organization if we didn't have disclaimers. So read this at your leisure, but it is basically, we're not offering legal or tax advice. This is an overview, and it is not going to cover all of the issues that will be faced by divorcing individuals. The scenarios we're presenting are for illustration purposes only, and they're not actually a real case. So we shall present general rules for addressing divorce, and we need to keep in mind that pretty much any general rule that we offer here are probably subject to some exceptions. So that is by way of saying that divorce financial planning is a complex matter. It is a matter that is likely to be faced by many of your clients at some point in time. So first we will start with the introduction.
Good afternoon, everybody. This is Tom. Statistics related to divorce are a little bit elusive, but it's safe to say that for a married individual in that person's lifetime, there's probably a 40 to 50% chance that he or she will get divorced. And the rate is even higher for second marriages. There are many complex financial issues surrounding divorce, and there are also some very deep emotional issues. And while we don't officially deal in the emotional issues, it's very important that we incorporate that into the process, because it's for many people it's a very painful and destructive experience, both financially and emotionally. And our role as a divorce financial analyst is to try to help people through the process and do the best we can for them from both a financial and an emotional standpoint.
Okay. So what we will cover this afternoon is that we will cover both income issues and asset issues with respect to divorce. On the income side, we have children issues, so child support and things like that, spouse issues, alimony, which is also called spousal support, Social Security, health insurance. On the asset side, we will cover asset division, in particular as it relates to retirement assets in the family home, the issues that come with trading assets, meaning, say, a portion of a retirement asset in exchange for a stake in the family home. We will also cover throughout benefits of financial analysis as well as long-term planning.
It's very, very important that people who are getting divorced try to get an understanding of the landscape as early in the process as they can. And even though many divorces carry on for quite a long time, the issues tend to fall within a predictable range. There's a division of assets, there's issues of support, either spousal or child support, and that, for the most part, is what divorce is all about. But it never ends up being that simple. But we as financial analysts provide a roadmap and give a general understanding of the landscape so that our clients are empowered to make informed decisions. They have more control over the process of their own divorce. And hopefully by being more informed and controlling the process, they can end up doing it less expensively than they would otherwise.
So before we proceed into the financial aspects, so we have to remember that divorce is, to a large extent, a legal process. And there are several process options that are available to people who are divorcing. The first one is litigation, which is the standard way of addressing it, the one that most people are most familiar with, and that involves each party hiring a lawyer and having the lawyers duke it out. The second most important process option out there is alternative dispute resolutions, which fall principally into two categories, which is mediation and collaborative law. In mediation, what happens is that you have a mediator who helps the two parties negotiate with one another. In the case of collaborative law, it's a little bit more complex. Each party has a lawyer, and there is a coach which is similar to a mediator, but not quite the same, and there is often a financial neutral. And the third option is a do-it-yourselfer. It's actually the most popular option, and it may work well in many cases, especially for people who do not have children or assets. The fourth that we list here is limited representation, which is really a subset of the do-it-yourselfers, and that is when the parties will hire a professional, such as a lawyer or a financial planner, to do some specific work for them, such as check an agreement or do a calculation or something. What is important to note from that is that divorce is going to be expensive, regardless of the process that people choose. The litigation is notorious as being very expensive. Do-it-yourselfing can be also very expensive, especially because the people doing it are typically not experienced in divorce and are likely to miss on important issues as they go through it. What we want our clients to do is that we want them to be not penny wise and pound foolish. We want them to find a balance between the expense of representation and the return. In our case, what we try to do is that we help guide them to a process that is appropriate for them.
Because the discovery process in divorce requires the gathering of a tremendous amount of documents, and it's very important that people do this early in the process and try to do it completely. It creates a lot of problems if documents continually have to be updated. So to the extent that you can gather all your documents in the beginning, and those will relate to assets and income, retirement accounts, checking accounts, and that you should be aware of the contents or at least the existence of things like safe deposit boxes. It's important that full disclosure is part of a divorce. One doesn't want to have to be called back to court on a contempt for trying to conceal funds. It's also very important, especially for the spouse who's not the major wage earner, to make sure that there is enough money available to that party to cover their expenses during the divorce, to pay the lawyer. So it helps to prepare early to make sure that's covered. And it's also very important that individuals seek out appropriate professional help early in the process. We specialize in that area, and we feel we can be of great benefit to our clients the earlier they talk to us, so they better understand what the issues are when they eventually talk to a lawyer. In Massachusetts, there are required disclosure documents that are listed in the Rule 410, which is the Massachusetts form, and that supplies the scope of everything that has to be provided. It typically involves providing 3 years of brokerage statements, retirement statements, savings and checking accounts, and mortgage statements. The Rule 401 statement is in Massachusetts, is the single most critical document that's provided to the court. This is a listing of all the individual's assets and liabilities and expenses, and it becomes a permanent part of that divorce file, so that if the party ever ends up having a trial, the individual can expect that anything that he or she put on that form is going to be dissected with their testimony. So it's very, very important for it to be accurate and complete. And in doing the Rule 401 financials, it provides a good head start toward creating a budget. And budgeting becomes very important in this process because parties are going from living on a budget that is created using 2 incomes to, after divorce, living on a much more Spartan budget because it only involves 1 income. And it's a help to the client to understand both their marital lifestyle and also be able to compare that to a budget that they create for what will be their life after divorce.
Okay. So child support is an important factor in a divorce. For most divorcing couples, the children are the most important issues. Most parents and most clients usually agree that this is a case and that they want to consider the children's best interest. We like to think that we're only the second most important issue. And so, however, when it comes to financial issues, child support issues, finances end up being an important factor. So child support in Massachusetts is governed by the child support guidelines, which are available at the link on the screen, and is calculated, is basically a formula. And so the factors in the formula are the income of the parties, and it is based on the difference in income of the parties, on the number of children, and it is not linear. It's not like having, say, 2 children results in twice the child support. It's less than that. On the percentage of parenting time, and on the age of the children. One of the interesting factors with child support is that typically the first $250,000 in combined income are considered in the formula. The excess over $250,000 can be considered, but is not necessarily considered. And the tax impact, I think that most of you know that child support is not deductible to the payor and is not taxable to the recipient. So what we're going to do next is that I'm going to go through a quick example of how the child support is calculated. In our example, Dick and Jane are getting divorced. Dick is self-employed with a Schedule C income of $180,000, and Jane has W-2 income of $60,000. They have 2 children, Ted and Sally, and they share custody. What you're seeing there is a snapshot of the form, the actual form that is used by the state that calculates the the child support. And what you see that very much on top is one of the peculiarities of divorce planning, is that the recipient, who is Jane in this case, her income is $60,000 and is calculated on a weekly basis, which makes it $1,153 for the week. What you see is Dick on the right there, who is a payor, has $180,000, and so it translates into $3,461 per week. All the way at the bottom, what we see is the net result of the calculation, which is $704 per week from Dick to Jane, and that works to $3,050 per month, and or $36,608 per year. So this is just a quick example of how the child support works.
In addition to child support, the other major category of support is spousal support, which is just another term for alimony. In Massachusetts, there was a major alimony overhaul in 2011, and the main characteristic of this overhaul was that for the first time in Massachusetts, the length of the term of alimony was directly related to the length of the term of marriage. It also created other types, I'll get into that in more depth, but it also created other types of alimony, and it stayed consistent in the guidelines for calculating alimony, and we'll also spend a few slides talking about the tax impact of alimony. So most alimony in Massachusetts is considered general alimony. What you see on this slide are the additional, more specific types that are typically short-term. You can see under duration that they run between 3 and 5 years. And these are for cases where there's an attempt being made to try to make one of the parties self-sufficient, maybe by going back to school or teaching a skill. The reimbursement alimony could be in consideration for perhaps helping the other spouse go through graduate school. Transitional alimony might be based on a relocation or another adjustment to one's lifestyle. This slide gives the specifics of the alimony duration as they relate to the length of the marriage. And you can see it goes from, for a marriage of 5 years or less, that alimony, and again, these are general guidelines. If you do alternative dispute resolution, you have the opportunity to agree to whatever the parties want to agree to, assuming the court accepts it. And if you go to court, these are the guidelines that the judge will use, but there are many issues that can enter into it that can affect these guidelines. But in general, for a short-term marriage of 5 years or less, the payor won't pay alimony longer than 1/2 of the length of the marriage. And for a marriage for 15 to 20 years, for example, it could be, the alimony period could be up to 80% of the length of the marriage. And for a long-term marriage of more than 20 years, the general alimony can be indefinite, and it typically ends at the age, at full retirement age, as defined by Social Security, of the payor. There are very specific rules that are required in order for alimony to receive the tax treatment which it receives. Unlike child support, which has no taxable impact, alimony is deductible to the payor and taxable to the recipient. Payments have to be made in cash, check, or money order. There has to be a formal written agreement that specifies the alimony. The two parties can no longer live together if one is paying alimony. Payments have to terminate on the death of the recipient. The parties can't be filing a joint return if they're going to claim that alimony is being paid. And again, it has to be distinguished from child support. Okay. Now, here's a a fairly simple example to give a sense of what the guideline is for general alimony. One party makes $100,000 a year, the other party makes $40,000 a year. The difference in their incomes is $60,000, and according to Massachusetts guidelines, roughly 1/3 of the difference, or $20,000, would be the guideline for alimony. In the statute, it's the exact percentage is somewhere in the 30 to 35% range, and we often use the halfway point, 32.5%, for the calculation. And again, this particular slide or scenario assumes that there's no children or child support, because any child support that's paid also influences the amount of income that figures into the alimony calculation. There are a couple of other things to consider. The courts will consider things like, in terms of whether they should depart from the guidelines, things like the age of the parties, the health of the parties, the employability of the parties. And another thing that's very important is to make sure that the alimony payments don't run afoul of some very tricky recapture rules, because the court doesn't want parties to claim alimony for something that's really, in practice, child support, but the parties are just looking to get the tax advantage. And one other thing on this slide is that if there's a material change in circumstance for either the payor or the payee, the parties have an option to seek modified terms, and there are also ways to try to calculate lump sum buyouts of the alimony stream. In order to try to take advantage and stay clear of the recapture rules, it can often be of benefit to the parties taken as a whole to characterize payments, support payments, as alimony as opposed to child support. Here's an example where we have three cases. There's substantial difference in income between the two parties, $340,000 annually for one and zero for the second one. And the parties have agreed to pay a total of $110,000 per year in support. And these three scenarios show what the tax impact is of treating those support amounts as either all alimony, which is the case in scenario 1, all child support, which is the case in scenario 2, or split it 50-50, so it's half child support, half alimony. And you can see in the bottom line in the grid that the total income available to the parties after tax is by far the most if they treat it all as alimony, and it's the least if they treat it as child support. So it can often be a benefit to the parties to do this kind of analysis, and it's what we as divorce financial analysts do on a regular basis. And then some other equalization has to be done to compensate the party who's paying an extraordinary amount of taxes in order to achieve this situation. Okay. Now we'll move to Social Security. Divorced spouses have many rights that are similar to married couples when it comes to claiming Social Security benefits. A divorced individual can claim either based on benefits based on his own earnings, or he or she has the right, as long as he was married or she was married for 10 years and is at least age 62, can claim the spousal Social Security benefit, which, similar to it is between married couples, is typically 1/2 of the spousal benefit. And
government, if there's a government pension involved for either party, that can also, the same way it does for non-divorced spouses, can affect the amount of the Social Security benefit, where the Social Security benefit can be reduced by some fraction of the government pension. If one is claiming a spousal benefit and that spouse remarries, that can have the effect of ending that benefit. And also, if an ex-spouse dies, the surviving ex-spouse may be eligible for death benefits based on the ex-spouse. And I just want to point out also that the ex-spouse isn't even aware that their ex-spouse may be claiming benefits based on their record, and it doesn't affect the benefits directly of the other spouse if somebody claims the spousal benefit.
Wonderful. So one of the issues that comes with support, whether it is child support or whether it is spousal support, is the question of what happens when the person who pays dies. So it's very simple, is that typically when that happens is that support will end. In fact, there are specific requirements for alimony, which Tom went through earlier, that says that it will stop upon the death of the payor. And when that happens, then the recipient may be left without financial means. So typically what happens is that life insurance will be used to cover for that possibility. There are a number of issues with respect to life insurance. We know as financial planners that clients in general are underinsured, and divorcing clients are often underinsured also. One of the key problems is one of how much life insurance is needed, and obviously they will need more early in the divorce than they might need later in the period of either child support or alimony. Since later in the period there's fewer contingencies to cover for. So that requires, I think, a discussion with clients and a balance that needs to be reached between saving money and getting the coverage that they need. Other issues that come with life insurance is a question of who pays a premium. In a typical case, what normally happens is that the payor of the support will pay the premiums, and they will also own the policy. That is not necessarily optimal. That is something that needs to be reviewed and something that needs to be discussed and agreed to as part of the divorce. Health insurance is another issue. There are typically three options that are available to divorcing people. One is to continue on the same plan, and that is generally available in Massachusetts, except with some exceptions, right? So the law requires it, but there are exceptions to what is to where it applies. For those exceptions, COBRA is available, and COBRA is available as for 36 months instead of 18 months. As we know, is that COBRA is usually available for people who are being laid off for 18 months. For divorcing people, it's available up to 36 months. The last option there is to buy a new policy, and that has been made much easier with the healthcare reforms of the past few years in Massachusetts and nationally, and as it allows people to change policies without considering pre-existing conditions. There is a cost and there are tax implications to this. In particular, one of the possibilities for the spouse that doesn't make as much money is that they may, in fact, qualify for a subsidy under the healthcare reform that has been implemented. The other issue is a question of cost, especially if they continue on the same plan. If they continue on the same plan, the share of the ex-spouse the share of insurance of the ex-spouse now becomes imputed income for the employee that they have to pay taxes on. So there's a little bit of planning that needs to happen in terms of figuring out what the amount is, how much the tax is, and who is going to pay for it. So we're moving now to asset division issues. For asset division, there are a number of things that need to be considered. Retirement assets is a big issue. The marital home is another big issue. Brokerage accounts, and then there are a number of other issues, other assets that can be divided, including other non-retirement assets, businesses, stock options, restricted stock units, property that may be considered separate, and inheritances. For the purposes of this presentation, because we only have so much time, we will only consider retirement assets and the marital home. One of the things that we want to consider with respect to retirement assets in particular is the different tax impact of those assets. So we know that DC plans, for instance, defined contribution plans, are pre-tax money, and these are 401ks, 403bs, 457s that you have to pay tax on when you take distributions in retirement. Right? Defined benefit plans, these are the pensions, are different in the sense that there is not really an account balance, but there are, when payments happen, they are also taxable. Annuities are a little bit of a different animals in the sense that clients will buy the annuities with their own post-tax money, and they will pay taxes on the earnings of the annuity, but not on the principal. And Roth, of course, are post-tax money that are tax-free distributions. So the chart on the left there shows that each different instrument there may come up with a different after-tax value. When it comes to dividing retirement plans, it's helpful to remember that all plans are different. Not all 401ks are the same when it comes to dividing them, and the differences are contained in the plan document, and what is different there are specifically how it gets to be divided. Defined benefit plans are specifically different because each plan is written differently. At least 401ks all have pretty much the same framework. Defined benefit plans can be much more different. The most common example in Massachusetts is a state pension plan for teachers, police, and other state and municipal employees. They provide the beneficiary a stream of income from a defined start of retirement until death. They are not portable. The value is difficult to determine. In fact, clients will often tell you, my pension has no value, and that is because they get a statement that says it has no value. That, of course, is not true. A stream of income does have a value, as we all know. They have complex rules, right? And so in order to have a fair division of assets, defined benefit plans must be valued, and often clients will resist that. These plans, like the DC plans that we talked about and the defined benefit plans, are divided by QUADRO. QUADRO stands for Qualified Domestic Relations Order, and it is a court document that has to be done separately from the divorce agreement to divide the plans. They're used for qualified plans, such as 401ks and defined benefit plans. Similar documents are used for non-qualified plans, and they're called DROs for non-qualified plans. It's a domestic relations order, and the federal plan uses a COAP, a COAP, a court order acceptable for processing. It's all basically the same general principle. It's important to consider that they need to be handled individually. So one of the issues that happen is that often clients will be interested in trading an interest in a retirement plan for interest in another asset. And so that is a complex issue that we will address a little bit later. Lastly, IRAs don't require a quadro. They can be divided straight from the separation agreement. And just as a note, I've just noticed that I've used separation agreements, and earlier I've used divorce agreements. They are, for our purposes, the same thing.
In terms of marital assets, in a very high percentage of divorces, the marital home or the family home is the single biggest asset. And it's also the asset that often carries the most emotion with it. As a knee-jerk reaction, many individuals who are getting divorced will say right from the beginning, no matter what, I want to keep the house. I raised my kids in that house, I painted that house by hand, and I'm going to keep it. And it isn't always the best financial decision, and a big part of what we do is to do the analysis on the marital home. And there are basically four major ways to deal with the marital home. The parties can sell the house and split the proceeds, which tends to be the simplest and the cleanest from a divorce standpoint. One party can buy out the other, which is often done. The major obstacle in that option is to have the party that keeps the house able to qualify for a mortgage, because a refinance is often required as part of the buyout, to have that party qualify for a mortgage on his or her own. Another option that is often used when couples have maybe teenagers who are close to high school graduation and the parents don't want to have to move and upset the kids' schooling, is to have one of the parents continue to live in the house, both parties continue to own the house, with an agreement that in some future date they will sell the house and split the proceeds. As long as that sale is done incident to a divorce agreement, and that future sale takes place within 6 years, both parties are still able to utilize their capital gains exclusion, which is $250,000 per person. And in any analysis that relates to selling or dividing the marital home, it's important to do the analysis to make sure that, to the extent possible, people's right to that capital gains exclusion is protected. It's very important to help the parties understand whether this house that they may be emotionally attached to is really something that they can afford. And that's where, the previous discussion on budgeting comes in. There are very strong emotional ties to the house, and this comes up again, and it's just very important that we as financial planners recognize that while the money is important, we have to be aware and certainly put some weight in those emotional issues.
Okay, so we've talked earlier about trading assets. I've referred to it a couple times, and so we'll run through an example of trading an asset. And so in this example, Dick and Jane are divorcing, and they have a home with $230,000 in equity, which is under the $250,000 threshold that Tom just referred to. We have a rollover IRA with a $170,000 balance, a brokerage account with a $60,000 balance, and Dick and Jane will retire at 67. Jane will be collecting spousal Social Security benefits, which means that she will be getting half of Dick's benefit. So Jane would like to keep the home, and she would like to trade her interest in the financial assets in order to keep the home. So if we take all of this data and we put it into a spreadsheet, it might look like that. It might look like Jane's home. In Jane's column, you see the home at $230,000. In Dick's column, you see the brokerage of $60,000 and the rollover IRA of $170,000. So we might say that it looks pretty much alike. So we've talked earlier about the issues with retirement assets in particular, and about the tax liability that they often carry with them. So the home, again, has no tax liability built into there. The equity of $230,000 is under the $250,000 exclusion limit. Right? However, the brokerage has a brokerage account has a cost basis in there, and the difference between the value and the cost basis is taxable, hopefully at long-term capital gains rate. The rollover IRA has the income tax that is built into it, right? And so this is what it looks like after you take the tax into consideration. The Dick's brokerage account is now worth $55K after tax, and the IRA is worth $118K after tax. So in this particular scenario, what it looks like is that Jane's share of the assets is $230K after tax, and Dick's is $174K after tax. Right? And so I'll restate again the assumptions for long-term planning purposes. So this might look in the short term as something that is favoring Jane. However, we also want to consider for clients, whether they come in as couples or as individuals, what the long-term implication of a scenario like this one would be. So we're set again, Dick makes $180K and Jane makes $60K, and Dick will pay Jane child support of $36,608, actually $608. So this comes from an earlier slide that we talked about earlier. And she will get spousal Social Security benefits, so half of Dick's benefit. So she will keep the house, and Dick will keep the brokerage and the IRA, as we've just discussed. And so the long-term impact of that looks a little bit like that. And on the top line, what you have is Dick, and on the bottom line there you have Jane. And what happens with Dick is the impact of having a higher income, and therefore the ability to save for the long run. And what happens to Jane is that she has a lower income, she has a more expensive asset, and in 2019 what you see is that she's losing some child support, and later on she's losing more child support. And what happens in 2027 is that they are retiring, and so the curve for Dick is flattening because he no longer has income and has to live off his retirement asset. And the same thing is happening to Jane here. She's been living from 2019 to 2027 off the equity of the house. And so one of the reasons that this happens is that child support goes away eventually. The house expense don't really go away, and the retirement assets keep growing. Right. So it's important to note as we manipulate all of these numbers that we need to try to give clients a realistic perspective of what the short-term impact of divorce is and what the long-term impact of divorce is. In general, people focus a lot on tax implications, and they are terribly important, but they typically happen relatively in the short term. And people tend to not focus as much on long-term implication, which I think are just as important.
And even though we work in the world of finance and financial analysis, emotions make up such a huge part of divorce. People are angry, people feel guilty, people want revenge, sometimes they experience relief. There's a huge difference between
the attitudes of the party that initiates the divorce versus the non-initiator. Things like the behavioral economists have studied, things like loss aversion and anchoring have an awful lot to do with the way people view the money. Because you can say that it's all about the money, but that view of the money can be greatly distorted by the emotional biases that we all have. And we have to constantly be aware of the fact that those are part of the picture, and we deal with those emotions every day as we deal with divorcing clients. People can have irrational emotional attachment to certain assets, and we find different ways to deal with that. Divorce is not a zero-sum game. It's not that one party's a winner and one party's the loser. It's trying to incorporate all kinds of analysis so we can come up with a fair and equitable solution that everybody can live with, that we protect the interests of the children, and we try as best we can to keep people's psyches intact as they go through this difficult process.
Okay. So marriage is about love, and divorce is largely about money. And so what we do is that we try to help clients make sure that they understand the money part. And we recommend for clients, for your clients, that they get the divorce diagnostic up front so that they can figure out what the roadmap through divorce is and what the likely scenarios are going to be and what their consequences are. We also recommend that they resolve it through ADR, alternative dispute resolutions. We find that litigation often ends up really souring the relationship between the two, if it needs to be soured anymore, and that it ends up costing a lot more, leading to actually the same result that they would lead to anyway, right? So that's our presentation for today. We want to thank you for joining us. And if there are questions, I guess Kristen can take us offline.
Hi, Chris. Thank you so much, and Tom, thank you as well. We had a question about was there a mortgage on the home that you were referencing?
Yeah, there was a mortgage on the home that we were referencing, yeah. And so in that particular case, in the examples that I ran through, she would also have had to refinance her mortgage. Does this answer the question? Or?
Yes.
Oh, so I don't remember the exact number for the mortgage on the home. Keep in mind that this is a hypothetical example, and in the end, the issues with a mortgage are one, if she can't afford it, right? In that case, Jane was making $60,000 a year, and so she has to be able to afford it, and that means to meet the normal income standards. And so there are possibilities where the Jane in this case may not be able to refinance in her own name, in which case it creates different complexities, right? In which case she may actually be forced to sell the house.
I think that's all we had for questions. Anybody else have a question? Well, I think that's it.
Well, very good. Thank you all for joining, and have a good evening.
Thank you.
Thank you.